Hey, this is Geoff Gannon, and you're listening to the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To get even more content from me and Andrew, sign up for the Focus Compounding app. The Focus Compounding app costs $7.95 a month. It comes with a bunch of 2,000-word articles from me each week, a fresh batch of 5-minute videos from the both of us, along with one bonus extra-long episode of the podcast each Saturday, and immediate access to our complete backlog of 200-plus episodes. To sign up, go to focuscompounding.com/app or wherever apps are sold. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to my co-founder, Geoff Gannon. Geoff, how's it going today?
It's going well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. Today's podcast, we're going to spend some time talking about entertainment stocks. So we could go over restaurants, we could talk about cruises, we could talk about movie theaters. Pretty much my favorite things in life.
Okay.
Movies, food, vacation, all the good stuff. Right. So let's go over. We could throw in some hotels too if we want. And the first one we have is Carnival Corporation. You talked a lot about this stock. We've talked about it personally, and then we also talked about it as a stock that you would consider if you were forced to invest in a company that is larger than $10 billion.
Right.
And you think that Carnival is going to win out, or probably has the best odds of just being a great stock, over the next 10 to 15 years, as soon as they, get people to get on cruises again, and you don't think that industry is going to die or anything like that?
Sort of. I don't think the industry will die.
Yeah.
I don't know about the specific companies, and I'm not sure if Carnival will be a great stock in it, but if I had to pick something over 10 billion, it's interesting. I don't know that it'll have amazing growth and things over the next 10 years. I don't know that it's amazingly cheap. It's not amazingly cheap.
I do like your thought process, though, how you compared Carnival to the airlines, for example, and how you think there's going to be less cruise ships, and you think there's going to be there's going to be more airlines in the future. We've so, like from a supply-demand situation.
Yeah, we've talked about this. I'm very worried about the barriers to exit in the airline industry and subsidizing of it by governments all around the world. I don't like the airline industry nearly as much as the cruise ship industry, because I feel that the cruise industry is likely to have better ability to control its supply and demand issues of it. In fact, we've seen some divestitures by the major cruise companies and stuff, and I see that as promising. I think that they will better be able to cut their supply of new ships coming online, and their growth is strong. I think there's the possibility, long term, I think there's definitely the possibility for as much growth in the cruise industry in real terms as there is in airlines, airline travel and all that, and you're not exposed to corporations either. So I think, it's a much smaller industry. In terms of the oligopolistic nature of it. 3 companies, Carnival, Royal Caribbean, and Norwegian, control much of the supply, and even some of the other actors in it who have much smaller influence over supply, like Disney owns some of its own ships and stuff, are rational. I can't say that about airlines. And then just also, I think the financing of airline stuff is too easy, and governments are too in favor of it, and there's a lot of things pushing stuff out. There's some stuff of that in shipbuilding too. There's a few shipyards around the world, that only a handful, that build cruise ships, and they employ lots of people. And so the governments of those places are very interested in supporting those kinds of jobs, the same way like Detroit, the U.S. government kind of supports jobs in Detroit and stuff. But overall, I think it'll be much more rational. Yeah, I feel that in a few years, they could get supply under control so that when things do bounce back, pricing could be strong in that industry. Mm-hmm. And it was bad before. The other thing is they consume a lot of oil. So the two things that would be beneficial to them, always when I look at cruise stuff, I think, okay, will the price of oil come down over time? Will the fuel costs come down? And can we keep the supply constrained? Those are the two things you need. The two things you fear are that oil prices are lower now than they will be in the future, so they're going to go up while you own the stock, and that there's too many new ships coming online. So you want to be somewhat contrarian in this industry compared to when investors like it. We can see this down at the bottom. You could invest in 2013, 2014, when return on equity was 4 or 5%, knowing it would be 12 or 13 in a few years, because what was the price of oil back then? It was pretty high. And what were the new ships coming on? They were slowing down new ship stuff, in part because of oil. oil was hurting their returns. So they were thinking, okay, how do we like not build too many ships and everything? And you can read the 10K for each company and see how many new ships they expect to be delivered to them. So you practically see the whole industry. I mean, like by name, we know what ships are coming online. That's how well you can know this industry in terms of supply and demand.
Yeah, I think back then oil had to have been closer to $100 per barrel.
And they use Brent off of it. So I think they talk about their pricing of about $110 a barrel because the Brent spread was bigger than normal during that period. Yeah.
Yeah. Funny story. When we were on our research trip last week, Geoff was selling cruise ships, pretty hardcore to me. And I decided once cruises become a thing again, I'm taking a trip to Alaska. I've never been on a cruise. Geoff has been on it once or twice, a couple times.
Yeah. I told you Alaska. I don't know that you'd like Alaska. Alaska's pretty expensive and skews older. So I don't know.
That's my crowd. Are you kidding me?
Might be. Yeah. So that's one of your possibilities. I don't know. I think Caribbean is more your kind of thing, but we'll see.
What is that? What's Caribbean? Oh, like going to the Caribbean. Got it. Yeah. Well, I'm still. I've never done it before, so I'm like, well, I can't have an opinion unless I experience it myself. So I'm gonna. I was actually. It was funny when we got back to the hotel that night. I was looking on Carnival's website trying to see when I could book a trip. So I thought that was fun.
We had talked about leaps. And so one way possible to do this, if you do want to invest in a company like Carnival, and you can invest in either of the two other ones, we could look at the other two publicly traded ones. They're Royal Caribbean and so RCL and NCLH, I think are their tickers. They're not really cheaper than Carnival, and I'm not sure I like them as much. Royal Caribbean has the best ships in the industry, and for various reasons that have to do with that, I think people got very excited about the company in the last few years. I don't see it as a huge difference in terms of management doing really smart things as much as their strategy made a lot more sense. And it's kind of technical to get into it and stuff, but because of the nature of things in the cruise industry, I think having these mega ships, but fewer of them, was more got you higher returns than a Carnival, which had more ships but smaller ships. So the biggest ships in the world, like we were talking about Oasis class and stuff, that had been built by Royal Caribbean. So for reasons that have to do with fuel and other stuff, I think that helped them.
What's Norwegian Cruises?
NCLH, I believe.
NCLH.
Is that it? Yeah.
Good memory.
Yeah. Now Norwegian probably would be more your style of cruise in terms of how they market things and stuff.
Like what?
Norwegian's big thing that they've been pushing in terms of their marketing is allowing people to have more choice. So they give a bunch of perks and stuff, and then you choose how to use them, and then you decide like when you want to eat and things like that. It harms the economies of scale in the industry, but it's seen as attractive, and it makes a lot of sense if you're the third place player to try to differentiate yourself from the things that the first place and second place companies do.
Sure. All right, let's go over Geoff's favorite personal company, I would say. Cinemark. Doesn't mean he likes it as a stock or a business, but he loves it personally.
As a business, I like Cinemark by far in the U.S. compared to
even better than AMC.
Oh, much better.
Why is that?
I don't like AMC that much.
Really?
I mean, AMC was cobbled together by a bunch of different things that you might have seen that were in more urban areas and things, but both of them own a lot that are in malls. So both of them do that. Cinemark does have some larger standalone things too. I guess that's true. Cinemark bigger in this area. Cinemark's HQ is about a mile or less.
Yeah, it's like 10 minutes.
Yeah, it's not 10 minutes. It's
by walking.
Maybe. When we were talking about the field, the last piece of developable land around here is right next to Cinemark's location. Cinemark does not own the property though. Cinemark doesn't own any properties, but all of their corporate functions are done in a few towns around here, in like Plano and places like that. I mean, in like Frisco, McKinney, and stuff like that.
So, do you like Cinemark?
Yes. I don't think the stock's that as cheap as you would expect. So, for instance, EV to sales here is just one time.
Yeah.
That's interesting. I mean, it's a little cheap because if you look at operating profit, right, that's close to 15% in some years. What is it?
Yep.
Yeah. So then you tax that and everything, and you end up with a number that would give you like about 10 times earnings. But considering that until only a week or so ago, almost all the movie theaters in America were basically closed, or not showing new movies that would be attractive to people, it seems not that cheap. I would say it doesn't seem distressed, right? The price. But yeah, of the movie theater chains, I like Cinemark the best, and you can see that it ticks all the boxes in terms of key ratios that I would focus on. It consistent. I mean, we talked about this a little bit before, but revenue growth almost every year, gross profit growth almost every year. There's just other things about the economics of it that have been improving.
Like what?
Concessions. So I mean, but for like 20 years, it's been improving in terms of the average spend that they're getting per person and the amount of gross profit. They've been able to sell more and more concessions. They've redone a lot of their locations to have like luxury loungers and things like that. Helps increase the pricing because you're not necessarily going to get more people attending movies, but you can raise the price. So it's an industry where you basically raise your price every year on movie tickets. And you also raise your price in terms of, you also raise the amount of consumption they have of concessions that are more expensive. You change the product mix to more and more expensive stuff. And so over time, you capture more and more income per person that comes to each of these things. And they've done very well doing that in this industry. Industry is more rationalized than it used to be. It's cut down on the number of locations, things like that. Cinemark now has close to 1 million people, I think, as part of their loyalty program. Now, those people may have quit and stuff during COVID, but that's the other thing. So you have people who are part of your loyalty program, whether that's things like getting breaks on concessions and stuff like that, but it's a more rational sort of approach to like the free movie thing that we're talking about, right?
Like to Movie Pass.
Yeah, like Movie Pass. So each of these companies, AMC, Cinemark, each of them have this subscription thing that they do, the membership, and they've gotten them to meaningful sorts of numbers. And those people are your most common movie-going people, right? Because that's a big thing with these companies is that you have people who are very frequent moviegoers, and then you have a much larger number of people who are very rare moviegoers. You want to increase the frequent ones that you get.
Mm-hmm. How does that compare to AMC and Entertainment Holdings? Why do you like Cinemark more than AMC?
So I don't like the top levels of management and stuff at AMC and haven't, as opposed to Cinemark. To be fair, though, I think at lower levels, I don't disagree with them. So I don't, we were talking about the loyalty program, so like that, I actually think AMC has done great on that. Mm-hmm. So I don't disagree with their approach on those levels. It's the levels of like the top executives and up, maybe one level below that. So, but like, you know, when we talk about like C-level executives and stuff, certainly I don't like that. The investors, the board, the top executives at AMC as much as I do at Cinemark. You can find stuff on Cinemark in their presentations and also their annual reports and stuff. They've generally been with the company a long time and stuff like that. And their background, I like a lot. The people there. Cinemark also is bigger in Latin America, and they have certain clusters in some places. And the two places that I think they're pretty big are in Brazil and in Colombia.
Really?
Yeah, those are the two that they got bigger in. And I think that those make a lot of sense to do that. And in the U.S., they're bigger in places that I like in the U.S. more as places for future growth than something like AMC.
What did they do in 2013? Look, gross profit jumped massively,
well, that's
but revenue didn't.
That's an accounting thing. I don't know the details of that. Clearly, the gross margin that you saw before in 2010, 11, and 12 was site level. And then after that drops from being site level. So they're adding that to their operating expenses, as you can see there. So it probably meant that their sites were making like 15% or something. And then there was an accounting change that changed that afterwards. Because the gross profit number of like 60% makes sense as a gross profit. Mm-hmm. You can also see that Cinemark runs itself more conservatively always than the others. Now, they all lease their locations. Cinemark does not own, as far as I know, does not own a single piece of property. It's not like Reading, which a lot of people might be interested in. And we could mention, you know, Reading is a company that owns movie theaters and also live play theaters. So it's in the U.S. and Australia. I don't like the company as much and think it has some risks to it, but it has a very large enterprise value. So its market cap's only 115, but enterprise value is big.
Was it like $1 billion? Where do they own? Do they own their properties?
Yes. So they own the properties, and they are going to develop them into different things and stuff like that. So people like it because it's a mix of both of them. Mm-hmm. I don't know. I'm not even sure if it's a great merger target. Honestly, they own a lot of independent type theaters. The theater right here, a block away from here, is owned by them.
Got it.
They own it. So those are also like their tenants and stuff usually. And then in addition to that being a movie theater. So I go to the movie theater all the time, and it's an Angelica branded movie theater, which they own the Angelica brand. But I think it's a less attractive type approach than what Cinemark has. Cinemark has a lot of scale. I think the four biggest or so I would compare to each other. So and I think, you know, down to about the level of like a Marcus theaters. I wouldn't really go much beyond that.
That's what I went to growing up.
Yeah.
Yeah.
There used to be more independent ones. I think Carmike was independent, and there are a couple others like that, but they're mostly not independent anymore. So technically, this might be one of the biggest independent movie theaters that isn't owned by one of the other circuits, but it has very small market share already.
Have you ever been to an iPic theater?
No, I have not.
They have one in Allen, Texas. I know they only have, I don't know, maybe, I don't think there's like hundreds of them throughout the United States, but I know it's like there's a handful. It's kind of like it's the experience where you could, put your chair back and they have somebody that comes and waits on you, and you could, drink, and they order food and they make like a full experience out of it. I feel like that has you written all over it.
Yeah, AMC is pretty big in theater dining. Yeah, They were one of the pioneers in that, and they definitely pushed that out in a lot of different places. So they definitely push that to a big extent. That'll be interesting to see, because obviously with the coming back from COVID, the capacity utilization stuff isn't an issue for just watching the movies. So like if they tell them you can only have 20 or 30%, it doesn't matter. 20, 30% full is fine for movie theaters, not unlike restaurants. They make plenty of money doing that. But it won't work for places where they're feeding people, because those have to be full. So you have fewer seats and stuff in the ones where they're feeding people.
Why do you think drive-in theaters basically went away, or they got killed? I mean, there's not a lot of them. Got it. So you think it was malls? I think
drive-ins made sense before malls, and then once malls were in there, I mean, you can read in the Outsiders about general cinema, but I think the logic was to lease your locations in malls made more sense for places than to buy locations to focus on things being cheap for the land and stuff that you would buy. So when companies used to actually own the land outright, it made sense to pick locations that were somewhat close to population centers and stuff, but were cheap enough. And then after that, it made more sense for them just to lease locations in malls. It'll be interesting to see what happens now once malls decline a bunch. But you have to remember, like, for your age, it's not as noticeable, because you probably are familiar with the idea of like these, like Cinemark and stuff has these megaplexes, right? These ones where they build 20 screens and have a standalone. Yeah. That's a new concept, though. That's only been around like 25 years or something. Before then, it was all in malls. And so that kind of scale is something that these companies pushed later on in like the 90s and beyond. And they may continue to do that. And, but it's just a change in terms of real estate stuff. And it may change again in the future if malls become less popular.
Got it. What about Cheesecake Factory? We've talked a lot about it, restaurant stocks. And this is something that we've talked a lot about off camera as well, because a lot of restaurant stocks are very cheap right now.
Yeah.
QSRs aren't really, like, Starbucks and Chipotle and McDonald's and stuff like that, but actual restaurant stocks where you have to go, I guess, dining.
Yeah, I don't think restaurant stocks are that cheap.
You don't think so?
No.
Okay.
I think Cheesecake Factory is unusually cheap compared to other restaurant stocks. But in general, I think restaurant stocks aren't that cheap.
Yeah, it looks like it fell a little bit. And
I would be much more interested in cruise and movie theaters. Just like, let's give an example here. So EV to sales here is 0.7, right? Okay. Let's go to Cinemark, check their stuff.
Cinemark. Oops. All right. EV to sales, 1 times.
And price to sales is 0.6. Okay. So EV to sales is 1 times and EBIT is 10. Okay. And then go to Cheesecake. Yeah, it's about the same. So they're trading for about the same amount of pre-tax income. Which would I like better, Cinemark or Cheesecake Factory? Probably Cinemark by a lot. And we can just see that in terms of the difficulty of growing over time and stuff by a concept like Cheesecake Factory. Also, the fact that it's focused entirely on, you're risking it all on one concept. That can be difficult. Returns on invested capital probably are good at Cheesecake Factory, but not higher than you have in the movie theater business. Now, some people might say movie theaters have risks of that stuff going offline, but
they've been saying that for a long time, right? And you've talked about there's actually no evidence that that's actually harmed movie theaters and stuff like that.
Right. Well, it hasn't harmed the businesses, certainly, because of the rationalization of the industry. It's difficult to tell on an audience basis whether there's any less movie going in today's population than previously. The reason for that is the population that's most important to movie going is like 13 to 30. If you adjust for the fact and the changes in aging stuff in the U.S., I'm not sure that there's been any decrease in movie going per capita adjusted for age in the U.S. So I would say that movies culturally, like at a movie theater, are about equivalent to what they were 25, 30 years ago. Yeah.
Let's look at Six Flags Entertainment. We could go look at Cedar Point as well, or Cedar Fair, whatever it is. So they are, let's see, currently trading 4 times EV to sales. And I know that their parks they opened up again, some of them, and they were disappointed with the attendance since reopening. We actually drove past one the other day, and remember, it was kind of crazy seeing the parking lot just completely empty.
Was that the one in Oklahoma, not the one in Texas?
Yeah, right? Oklahoma. So they're all just, we could look at SeaWorld as well.
Yeah, I don't like any of these as much as the ones we talked about. I like Cheesecake Factory better. I like Cinemark better. Cinemark's not cheap, but as a business, I like it a lot better. Carnival has more long-term potential when it does recover. Carnival, the bonds have high yield, and people are very worried about it. But yeah, I mean, the pricing on it, you're getting a pricing in terms of like what historically its earnings have been and stuff that is in line with what we're seeing with your average restaurant, theme park, whatever thing. And this is much safer as a company, as a business, if it gets through its current liquidity issues. But I guess that's why these stocks bounce back, some of them a lot, is because of how easy it has been to get financing. And naturally, that would benefit those companies which are most imperiled. So the most marginal firms would bounce back the most, whereas companies that have better access to capital and stuff wouldn't necessarily bounce back that much. So it would make sense that like a restaurant 1/10 the size of Cheesecake Factory would bounce back more because it was seen as being closer to the brink of bankruptcy. And that might make sense also for some of the theme parks and things we looked at. Some of those theme parks, remember, have been passing all their dividends through. That's how Cedar Fair works. And also using more debt. Mm-hmm. A lot of things that I mentioned don't use a lot of debt. I mean, Carnival in the long run had been considered the safest of the cruise industry companies in terms of the safety of their debt, their credit ratings and things. Cinemark certainly is, of the major theater chains in the U.S., always been the most conservative in its approach, as evidenced by the fact that some of the others are kind of in bankruptcy or about to be in bankruptcy. And that's not an issue with Cinemark.
Yeah, and you were talking about how if you were to structure a trade for Carnival, you would look at the leaps as a way to do it.
So next year, there should be leaps available that run through to early 2023. And the reason why you would do that is because then you might be able to have exposure to the stock that you could eventually exercise the options after you knew more about COVID. Because presumably one way or the other, we'll see, but presumably one way or the other, you'll know a lot more about whether Carnival can survive and cruising can come back in January of 2023, which I assume is when there'll be leaps that expire then. So in 2021, you should be able to buy leaps that expire in early 2023. And that should give you enough time to get through this period with COVID. It depends on the pricing of the leaps and stuff, but so far from what I've seen, it looks interesting. It could look really interesting, especially because if volatility has been low, as it has been recently, then some options that go out to then will be really, really interesting because people may be pricing in far less volatility than they should be. So yeah, I would say leaps are definitely the way that I would look at it for Carnival.
Mm-hmm. Yeah, I like that approach too. Well, I want to thank everybody so much for tuning in with Geoff and I on the Focus Compounding Podcast. We are using QuickFS. If you do decide to sign up, make sure you tell them that you came from Focus Compounding. I want to thank everybody so much for tuning in. Hit those subscribe buttons, and we will see you in the next podcast.